Monday morning, good morning. I'm Guy Johnson alongside Valerie, Tytel and Lizzy Burden. We're an hour to the opening trade. What do you need to know? France firmly in focus this morning. Prime Minister Francois Bayrou's government will likely fall today. We're going to take you live to Paris for the details on that story. Sticking with the theme, Japanese Prime Minister Ishiba is to step down. Stocks actually reacting positively in Tokyo as the yen falls. And it is another big week for the bond market as attention turns to US inflation data Tuesday and Wednesday, Val.
These markets are faring okay after that disappointment NFP on Friday. We're still in the green when it comes to S&P futures, but just barely. Eurostoxx futures up 0.3%. The dollar really is going nowhere. Euro dollar at 117.15 ahead of that vote of confidence from France tonight. We'll get more on that story in just a moment. U.S. 10-year yields backing up just a bit from their rally on Friday, up 1 basis point to trade just below 410. The countdown to the opening trade starts right now.
Monday morning, good morning. Here in London, we're coping with the tube strike. In Paris, they are coping with political turmoil. We've got a lot going on around the world. We'll focus on Japan in just a moment. But France feels a little closer right now in terms of what we are watching. And Lizzy, it's a big day.
Yeah, we've got political upheaval in France, the UK and Japan. But we can first, before we talk about the market reaction, go straight to Paris for an update on what's happening ahead of that confidence vote. We can go to Caroline Gonin. She's outside the National Assembly in Paris. Caroline, Bayrou all but certain to go. What happens next?
That's right. We're just a few hours away from another government collapse in France, just 9 months after Michel Barnier's government collapsed in December. François Bayrou tonight will almost certainly fall in this vote of confidence that he has himself called for September 8 to increase the awareness of the French, he said, about the debt issue. And while many opposition parties have said they do agree on the debt issue in France, the need to tighten public finances, they do not agree on the method used by François Bayrou, which is to call this confidence vote before any discussions on the details of the budget. This is why the charm offensive of last week has not paid off at all. The Socialists and the National Rally of Marine Le Pen have all said they will support the fall of François Bayrou. What happens next really is in the hands of President Macron. At the moment, the most likely scenario is that he will name a new prime minister over the next few days. And in fact, many in his entourage are saying he should act really fast, really quick this time, not spending weeks trying to find the right person like last time, because we've also got something else looming, the social anger in France. In 2 days, some far-left groups have called to block the country. And next week, September 18, there is a more structured national strike called by all the unions. So Macron will definitely act quick. And at the moment, he has ruled out both snap elections and resigning.
OK, Bloomberg's Caroline Gonin in Paris. We thank you so much. We'll come back to you, Caroline, at 8:30 a.m. London time. You'll be joined by the French Socialist MP, Arthur Delaporte. But we really need to talk about market reaction here.
Cool.
Look, there has been a lot
Avant
of
qu'on me coupe, je voudrais
since...
faire ma promo.
I think we could just hear a little bit of Caroline there. But look, there's been a lot of market reaction since, as she says, Bayrou expected to lose, but that's priced in already. You've seen the CAC falling since that was announced. We've seen the oats bunt spread widening. It was 79 basis points the last time I checked. And now, as she says, it's really about what happens in the coming weeks and months. Do you see a significant weight on consumer and corporate confidence? Do you see more of a weight on French banks and domestically linked stocks?
Don't know yet, but we need to hear from Macron. We need to figure out what's going to happen. We don't know what's going to happen because he's not saying anything. Macron needs to figure out what he needs to do. He's got to do it quickly. The markets can't hang around this time. So I think that's the situation that we find ourselves in. Get on with it. You can't have 3 or 4 months of uncertainty because, as Lizzy says, that's going to hit the economic data.
Yeah.
Actually, you could argue French bonds have done OK.
Yeah.
during this process.
Absorbed the supply of last week pretty decently. They hung on to the rally that was led by Treasuries on Friday. But I thought it was pretty interesting what Bayrou said on Sunday to French TV, saying everyone is whistling as if this debt problem doesn't exist. And you have to think whether whatever government is going to be formed is going to seriously tackle this issue or not. It's clear that he's had some issues getting anyone on his side. Likely the next government is just going to keep on whistling.
Which is the same problem that you have for governments around the world. Look at the UK, and when you talk about the realities of the fiscal situation, nobody wants to hear it. But then at what point do the bond vigilantes say,
we need a crisis? Do you need a crisis? There's lots of editorials being written at the moment about the fact that basically the Labour government is currently failing, that what we need is for the Labour government to fail, so that the left and the right have then failed, so that everybody looks and goes, right, we need to actually address this on a cross-party basis. You could argue the same thing in France. France needs to come together, stop the political infighting, have a clear view of how to work forward and deal with the deficit, which is the largest in the Eurozone right now. The UK is facing the similar problem. You could argue Japan has many issues that it needs to face, and it's going to be really interesting to see how the bond market reacts to what we are talking about now, which is Ishiba stepping down. He has resigned. Shigeru Ishiba stepping down, basically ahead of what was effectively becoming a confidence vote. But here's the thing with that government, the next government. Are we going to see a new Prime Minister opening the taps? And that's the fear with the JGB market now, is that actually whoever replaces, because Ishiba is a fiscal hawk, whoever comes next may not be, and that's going to be a challenge for the BOJ. Can the BOJ cut in this hike in this kind of environment? There's a lot of things on the table there as well.
Indeed, and one of the top runners and riders to replace Ishiba is someone who loves Margaret Thatcher, did you know, is politically conservative, but as you say, wants to loosen fiscally, wants the BOJ to be a little more cautious when it comes to hiking. This is Sanai Takaichi, and so this is what potentially the market could be worried about. But when you talk about the BOJ, our economists, interestingly, I thought, were still expecting an October hike as of yesterday. Let's see whether that changes.
Yeah, so this political instability doesn't necessarily derail the path to normalization from the Bank of Japan. It just delays it again. They see risks, though, rising for that call of an October BOJ hike. But remember, the second front runner behind the one you mentioned who wants fiscal expansion is one that wants more structural reform. So it'll be interesting to see how the market weighs up these two maybe front leaders heading into that leadership contest early October, because they're different pictures.
They are, but the commonality here is quite clear. Structural reform is required. These are economies that can't continue to deliver what they are delivering for their populations at the moment. Change is probably going to be required. Structural reform is going to be required in France, the UK, in Japan, probably in the United States as well, to a certain degree as well, but we'll come on to that in just a moment. There is a theme here.
Yeah.
At what point does it happen, though, and what is the catalyst for it happening?
Yeah, and two more idiosyncratic things to Japan. One, does the new leader change the approach to the US when it comes to trade? Ishiba wanted to get that US-Japan trade deal done before he went. And secondly, do we see more hawkish foreign policy? Because that Chinese military parade clearly struck a nerve in Japan.
Yeah, well, okay, we've talked about Japan. Let's move on to another central bank that is capturing our focus. That is obviously the U.S. Federal Reserve. Trump saying over the weekend, late on Friday, our time, that the top three contenders are still the ones that we had reported way long ago. Waller, Warsh, and Hassett are still the front runners, maybe giving some confidence to the market that a wild card candidate hasn't made itself into the final inches of the race. Remember, the Wall Street Journal reporting that these interviews were being conducted by Treasury Secretary Scott Bessent on Friday. I thought it was very interesting to read Bessent's piece in the Wall Street Journal calling for a full independent review of the central bank, including its monetary policy actions.
And Hassett getting behind that as well, saying, we don't need that mission creep. Interesting as well to have Ken Griffin writing in the Wall Street Journal over the weekend, just really warning Trump that you've got to have an independent Fed, otherwise it's bad for the market.
What do we think about the market reaction to the payroll data? What do we think about the payroll data? What do we think about what is happening here? I've been thinking about this a lot over the weekend. You can make a case for the Fed not cutting here quite strongly. Credit growth is really strong. Unemployment's at 4.3, which is well below average. You could argue an immigration story that is affecting the data we're seeing in terms of the payroll data. You've got an economy that still looks fairly strong. You've got credit growth that looks good. You've got financial conditions that are super loose. Why are we talking, some people are talking about a 50 basis point cut this morning. Stephen Englander over at Standard Chartered, 50 basis points. Is that really what this economy needs? Are you cutting into a boom at that point in the US economy?
Well, it doesn't look like a boom in the labor market. The three-month run rate at 27,000, that is pretty disastrous.
Why is it at 4.3? Why are we still only at 4.3? Which is it's not. Is it disastrous when you've got an unemployment rate of 4.3?
That is a 4-year high.
Yeah, okay, 4-year high, but but well below average. And well below the kinds of rates that cause problems in the United States economy. All the other data points to a really solid economy. I'm just trying to play devil's advocate here.
I think, well, it's good to play devil's advocate because we know that the BLS data, the non-farm payroll data, has had a lot of skepticism over whether we can trust it. So instead of just looking at the labor market data, we do need to widen out the sphere to take in the totality of data, not just on the labor market, but on the U.S. economy. But many out there arguing that what Jerome Powell said at Jackson Hole means that he is focused more on the labor market. Sure. And this another weak print and the fact that June was a negative print really solidifies that the Fed will be cutting in September. October is still in question.
Yeah, is 4.3 weak? Is my question. Because
it's ticked up 0.2% over the last 2 months. That is showing a slowing and a loosening of the labor market.
It is. So in isolation, if you came down and looked at all the data in totality, you would say the Fed should not be cutting rates. I agree that the labor market is clearly weakening, but is it weakening because of immigration? Is that the reason for it? And does that have a signal for the economy in terms of what is going to happen with inflation and in terms of growth?
Well, let's see whether it deteriorates further, whether it's bottomed or whether this is the start of a downturn. And clearly that's the question that's in the mind of the stock market.
And remember, we get more revisions from the BLS. Yep. On Tuesday, they released their preliminary yearly revision. So in the 12 months to March 2025, Anna Wong thinks that we could actually get a negative print going all the way back to October 2024. And that the picture we get on the labor market is actually going to look very tepid after these revisions.
OK, so that's fine. So we've got a tepid labor market. Unemployment, immigration's been a factor. But all the other signals from the US economy during that period are strong.
Can you generate inflation if people are losing their jobs?
Well, you can, clearly, because if the labour market's been weak since October, you've got inflation that is north of 3% since then. So you clearly can generate inflation if you've got a weak labour market. If the data that is going to be revealed shows that the labour market's been weak since October and you've got inflation, yes, you can, is the answer to that question.
Yeah, and look, I think some of this Fed pricing will get pulled back on Thursday. We have CPI. Headline is expected to tick up to 2.9%. And most importantly, core inflation expected to be above 3 for a second month in a row. So we might see some of that pricing be shifted back after CPI on Thursday.
And of course, we're now in the blackout period, so even more of a focus on that data. You had Goolsbee saying on Bloomberg TV, the milder the CPI is, the better I'll feel about focusing on the labour market.
OK, so let's see what the data reveals. Peter Kinsella is going to be joining us from Union Bank Privé, Forex strategist, global head, is going to be joining us very shortly. I hope. There is a tube strike on in London. I'm just going to caveat everything this morning with that. Nicholas Forrest, Candriam, CIO, joining us on France. Nancy Curtin, Alti Tiedemann, CIO. She was really bullish last time she was on set. Does that continue? And Jens Eisenschmidt, Morgan Stanley's chief European economist. We have an ECB meeting coming up this week. I think that's going to be quite boring relative to everything else.
How dare you? I'll be there. It'll never be boring.
Yes, Lizzy will be in Frankfurt covering the ECB for us on Thursday. That is the main highlight of the week, at least when it comes to central banking in Europe. We do have a lot else to deal with. That main one catalyst today is the French vote of confidence happening later today. On Tuesday, Apple's unveiling its new iPhone 17 with a lot of the focus on the price hikes behind their new devices. Wednesday, U.S. PPI, which is very unusual to get PPI before CPI. It happens quite rarely. It's happening this week. Thursday, U.S. CPI, that ECB rate decision we just discussed. And Friday, some more data on the UK. We get GDP data, the monthly GDP data out of the UK.
The tube strike on this week as well.
Oh. Again. Look, so Monday to Thursday, little to no service. We've got an estimate of the economic cost here from the Centre for Economics and Business Research, CEBA. They say it's going to cost £230 million in a week, as you say, Val, where we've got UK GDP out, expected to stagnate, not what the government wants. Interesting, if you get a strong enough GDP print, that could take a November cut from the Bank of England off the table. So I want to forget about these strikes.
Can the government at this point, given what else is happening, be seen to cave to another union, which is the criticism that happened after it was elected, that it basically gave the train drivers what it wanted, and that has been a criticism that has stuck. If we get back into a season of strikes, how will this government deal with that?
It's another form of the doom loop. If you're giving away money and removing GDP, removing growth, you get less tax revenue to pay them in the longer term. Settle it quick.
we'll see what happens.
I guess Uber is going to be chairing these tube strikes.
So
there is one winner out of all
this the other day, and he was not happy about it. He says he wants a line of tube riders outside the train station to pick up, and they won't have any.
Oh dear, I still think Uber's going to have a pretty good day here. What else do we need to know this morning?
Well, let's get to that. President Trump saying that Hamas needs to accept his terms to end its war with Israel. His post on Truth Social comes after Steve Witkoff, Trump's envoy to the Middle East, sent a new proposal to Hamas last week. According to Axios, the deal includes releasing all remaining hostages in exchange for ending the war in Gaza. But Hamas says that it needs Israel to fully withdraw troops from the Gaza Strip to agree to these peace talks. Gaza's Ministry of Health says that the death toll in the enclave has surpassed 63,000. Elsewhere, President Donald Trump says that he thinks Russia's war with Ukraine will be settled soon. The US president reiterated that he's not happy with Russia, saying that he'll be speaking with President Vladimir Putin very soon. It comes after Ukraine and its capital came under a massive Russian drone strike on Sunday, killing at least 4 people. Kiev's mayor said that the strikes hit residential areas of the capital, while several other buildings also caught fire, including a government building. And oil climbing after OPEC Plus agreed to raise production again, but at a modest rate, highlighting some of the caution from the group as the market heads into an expected surplus. The group says it would restart 137,000 barrels a day of output in October, and the hike signals a reversal to cuts that were initially set to replace and remain in place until 2026. So a bit of a surprise market reaction perhaps to this supply hike. As I say, because it's a modest one, 137k, but maybe we get that drop over the longer haul.
Another tick higher in oil over the last few minutes. The reason for that, the EU apparently weighing new sanctions on Russia. That will hit the banking sector in Russia, which is already beginning to struggle, and obviously the oil trade that we have seen Russia relying on. The Union is apparently exploring new sanctions on about half a dozen Russian banks and energy companies. Latest round of measures to hit Vladimir Putin, but I will add, this is not the US wants secondary sanctions, and this is not secondary sanctions. The US wants the EU to kind of do what it's doing on India and on China and reflect what is coming out of Washington right now. That is definitely not, it seems, within this package, and you do wonder whether this is going to be too weak a package, therefore, to mollify the hawks in D.C. and what they're saying right now. It would be hard to believe that the EU would hit India hard, and it's interesting that you could argue that the EU is benefiting because India is buying Russian oil, refining it and then shipping it out to the world. Some of that is being bought, you could argue, within the European Union. Yeah,
we did hear from Trump on this topic when he was speaking to reporters after he attended the U.S. Open, saying he will be speaking to Putin very soon. He was asked also about the secondary sanctions, and he reiterated that nobody is tougher on Russia than me. But it's kind of leading a lot out there about what the U.S. is going to do, actually, in retaliation to Russia's strikes on Kiev over the weekend.
OK, what have we got coming up for you? ASML is reportedly set to become the top shareholder in Mistral AI. We're going to check in on the shares of the Dutch chip giant at the Open. Plus, we'll be live in Paris ahead of today's crucial vote, and we're going to hear from the French Socialist MP, Arthur Delaporte. Up next, though, back to the markets. Bond and FX traders following this week's big data. It's inflation is in focus now. We've got rate decisions. We've got the latest out of Japan. We've got to think about what's happening in Paris. All of that firmly focusing on the FX trade and the bond trade. Any questions? You want to join the show? You want to get in on this conversation? This is how you do it. IB, the plus symbol, BB, TV Go is the function. It's down there on the right-hand side of the screen. Get involved. This is Bloomberg. Monday the 8th, good morning. The Nikkei is about to close. It'll be closing in 8 minutes. It's up by 1.43% this morning. The reason for that is the yen is down really quite sharply. This, as we see, the resignation of the Japanese Prime Minister Shigeru Ishiba. It is setting in motion his resignation, a leadership race that will, of course, be closely watched by global investors.
I thought that as Prime Minister, I needed to take responsibility for the result in the election. Having seen the U.S. trade negotiations through, I felt that now was the right time to stand down and give way to my successor.
Ishiba says he will stay on as Prime Minister until his successor takes over. Joining us now from Tokyo for the latest is Bloomberg's Yoshiaki Nohara. Good morning, good afternoon. Thank you very much indeed for joining us. So just walk us through the process of what happens next and who we should be looking at in terms of who could succeed Ishiba.
So the next step is that for the ruling Liberal Democratic Party will decide when the party is going to hold its leadership election to replace Prime Minister Ishiba. And we are hearing that at this point that schedule is going to be decided tomorrow. And once that's decided, candidates will decide, whether they're going to formally announce their campaign or not. And what we are focusing on is at this moment is two candidates, I would say. One is the Sanae Takaichi, who is the coming from the right-wing camp of the LDP, and she's known for the aggressive monetary policy easing to maintain stimulus in the economy. And also we are paying attention to the Shinjiro Koizumi, who is the son of the legendary Prime Minister here, and given he is the current agriculture minister within the administration now, he is seen as more of somebody to stick to some continuity in policy to some extent. That's what we are looking at this point.
Yoshiaki, we thank you for taking us through those runners and riders. Yoshiaki Nohara, great to see you. Well, from the runners and riders for Japan's leadership to the runners and riders for the Fed's leadership, President Trump confirming that the top three candidates to replace Fed Chair Jerome Powell include the White House economic advisor Kevin Hassett, the Fed Governor Christopher Waller, and the former Fed Governor Kevin Warsh. In an interview yesterday with Face the Nation on CBS, Hassett spoke about the role of the central bank.
Central bank independence is something that, as you saw, there was a hearing this week about that Democrats and Republicans in the White House all agreed about. Now, the question is, has the current central bank been as independent as we would like, as transparent as we would like? And I think that there's some dispute about that.
Kevin Hassett, one of the three finalists to become the next Fed chair on central bank independence. He was also asked whether he's preparing an overhaul of the central bank. He declined to say that he was, but it comes a few days after the Treasury Secretary Scott Bessent wrote in the Wall Street Journal he wants a full independent review of the Fed and its monetary policy power. He was also asked about the BLS data, whether we can trust it. And he does agree with the administration that the data needs to be addressed. They do need to do things to modernize the survey. And I want to say that the revisions really don't stop with Friday's data. We have more to come on Tuesday from the BLS. They announced their yearly revisions from 12 months up until up until March of this year. Our own Anna Wong on Bloomberg Economist thinks that October can actually be revised and negative, and this could give us a worse glimpse or worse feeling on the U.S. labor market after June was revised negative on Friday's payroll print. But this kind of, softening of the U.S. labor market and expectations that it'll continue to soften is really what led that powerful rally in the front end. 13 basis points of a rally at the extent of the move on Friday. We have walked some of that back, but the market is still pricing in, Guy, a small chance of a 50 basis point cut from the Fed in 2 weeks' time.
Yeah. And you wonder what signal that would send and what message the market would take from that. It's going to be an interesting few days. We're certainly going to watch that inflation data coming up. It's going to be a firm focus Tuesday, Wednesday. But for Monday, we focus on what is happening in France. French bonds have just opened. We are up in terms of the yield on the 10-year, but not by much. We are up lower than we are seeing on, for instance, the German bond market. We're going to take you to Paris next. Nicholas Forrest, Chief Investment Officer at Candriam, is going to be joining us to give us a take on what we can expect next in France. I will leave you with a live shot of Paris as we count down to that vote and news on who comes next as Prime Minister. This is Bloomberg. Monday morning, good morning. 30 minutes to the start of trading here in Europe. This is what the future picture looks like. Actually, all right. So far, so good. This is the story we're looking at across Europe. As you can see, actually, CAC futures are positive this morning, but European futures generally are fairly positive. I would also mention that the Nikkei is closing right now. Yen down, equities up in Tokyo despite the political turmoil, maybe in spite of political turmoil that we are seeing. The yen is down, dragging equities higher.
Yeah, also a question of whether JGBs, the rise in 30-year yields, will be knocking European fixed income. It doesn't seem so at the moment. We still have German 10-year yields basically trading pretty solidly, unchanged. French 10-year yields as well. But those JGB yields just in the long end crept up overnight, higher by 3 basis points as we begin to worry about perhaps a new fiscal expansionary policy coming out of a new Japanese leader. But it does seem to be not having very much of an impact on European bonds nor on treasuries at the moment.
Let's turn our attention to what is happening in France. The collapse of Francois Bayrou's government looks set to plunge the country back into an acute political uncertainty and heightened doubts over whether any government will be able to rein in the largest budget deficit in the euro area. Let's find out what happens next. It seems almost certain that Bayrou is going to fall today. Caroline Conan is outside the National Assembly in Paris for us. Is it a done deal? And what's next?
It's pretty much a done deal, Guy. In fact, 98% chances, according to Polymarket, that Francois Bayrou will actually fall tonight. He has called this vote of confidence, but of course, the opposition parties do not like this method. They wanted to discuss the budget before going to a vote of confidence. So the charm offensive of Francois Bayrou meeting with all the opposition parties last week has not paid off. And of course, what happens next is now in the hands of President Macron, because Bayrou's fall is mostly priced in by the market. What is not necessarily priced in is what happens next. The likelihood, of course, is that he's going to name a new prime minister quite quickly, hopefully, over the next few days. That new prime minister might be from the Socialist Party, something he hasn't tried yet. But of course, that means some question marks for the longer-term trajectory of public finances, because the Socialists have presented a budget with only 22 billion euros of savings, half of the 44 that were proposed by Francois Bayrou. So that may worry investors, of course, about the longer-term trajectory of the debt picture in France. According to Bloomberg Economics, the debt to GDP ratio could actually go from 115% today to 125% by 2030 if nothing is done. Of course, an even worse case scenario for the markets and for investors would be snap elections or Macron's resignation. At the moment, Macron has ruled out both options. But of course, if the parliament is still fragmented, if the situation remains in a deadlock over the next few months, if they don't manage to pass a budget, he might just end up being forced to call new snap elections next year, perhaps around the local municipal elections in March, so he doesn't have to call the French to the polls twice.
Caroline, thanks for the update. That's Bloomberg's Caroline Conan out of Paris. We thank you. Well, let's stay with the story out of France and bring in Nicolas Forest, CIO at Candriam. Nicolas, we were just hearing there from Caroline, good morning to you, that, look, markets are already positioned for Bayrou's ouster. So what are you positioning for in the coming weeks and months?
Thank you for the question. So first, as you said, it's largely priced, so it's fully priced today. So we have been relatively cautious and negative, but for the time being, we believe that it's fully priced. What is important, of course, is what are the next steps? What are the next steps in terms of prime minister, in terms of potential new elections? But for the time being, we are not expecting dramatic volatility. We believe that we will stay in this high level, in this territory, close to 80 bips.
And as an investor, how much headspace do you devote to the rise of the far right? I get that it's a tail risk, but how do you think about that?
Yeah, that's a very good question. In fact, for us, we have different scenarios. We believe that the most likely scenario is to have a new prime minister. Macron will appoint a new prime minister from the center and from the left party. In this case, we believe that we will stay in a status quo. But if we have new elections, we have just two scenarios: a victory of the Rassemblement National or just the same unstable parliament. In these two cases, we believe that it's negative, and we believe that if we have new elections, if we have the Rassemblement National or if we have just the same coalitions, there is a risk to reach the 100 bips for the spread France or Etebun. So clearly, a victory of the Rassemblement National will create volatility, at least in the short term.
Nicholas, we also have the ECB meeting on Thursday, and Lagarde has said that she has an eye on this French crisis. The fact that it has raised the attention of the ECB, does that comfort you in your view on French debt and the French economy?
Yeah, I think first the ECB, they cannot really react and they should stay independent. But clearly the fact is we are observing a slowdown of the consumption and a potential slowdown of the investment. It means that if we continue to see a political instability in the largest economy like France, there is a potential new cut. I know that the market now is expecting a status quo, but we believe that it's not impossible to see further cuts by the ECB to support the European economy and also to decrease the interest rates, because that's clearly a risk. For me, today, the major risk for central bank, but also for France, is a steepening of the yield curve, the fact that the long-term rates are significantly higher than the short-term rates.
Yeah, Nicholas, we've seen that steepening not just in Europe, we've seen it in Japan, we've seen it also in the U.S. But you have to think whether, if the ECB is wading into this conversation, it's really going to create some sort of, perverse incentives for the French government. Let's say that perhaps we see the ECB stepping into the bond space before France actually gets any act together on their welfare picture, on turning around their pension spending. Doesn't that create some kind of issue which would concern an investor?
Yeah, it could create issues, but honestly, the fact is, for the French debt, what is very important is the foreign holders, and the fact that today is one of the largest debt held by foreign investor, with close to 55% held by foreign investor. That's also a good sign for French debt. So the fact that I think the ECB cannot really comment anything about the French debt, and we believe that we are not expecting a lot of volatility, except if we have new elections. And if we have new elections, if we have instability, well, that's a risk, of course, for long-term institutionals. But for the time being, we don't believe that, and this is not the most likely scenario for the coming days.
Nicholas, good morning. It's Guy. How systemic would a French debt crisis be? UK banks lend a lot of money to France. German banks lend a lot of money to France.
Yeah.
French banks obviously have a lot of OATs on their books. How systemic would a problem in France be for the rest of the Eurozone, for the rest of Europe?
That's a very good question. Today is not systemic, in my opinion. It's just that France has become really a weak man and one of the worst country in the euro area. And now, when you look at the French spread against Italy, it's flat. And the fact is just the market is pricing French debt as a single A. But do we believe that other and European banks will decrease French debt? Well, it's possible, but the fact is it remains the second largest economy in the euro area. It's an important debt, very liquid. When you look at the auctions, nothing was dramatic, but clearly we can see adjustment, but we don't believe that there is a clear alternative in Europe to just sell all the French debt. It's not possible, in fact.
Yeah, but I'm wondering how international investors, non-EU investors, will be looking at this. The Japanese, for instance, hold a lot of OATs. Is the BTP market an alternative if they are basically judged as being the same credit? How do you think international investors will be looking at that? Will they be diversifying? Are they comfortable sticking in French debt for now, knowing ultimately that at some point there has to be a reckoning with the French deficit that needs to be resolved at some point? Do you think investors are kind of getting ready to move?
You're right. I think this is the most critical point, because we have seen a dramatic increase from foreign holders over the last 5 years. And clearly, this is something that we need to monitor. And we believe that, yes, Japanese investors or Chinese investors can decide to slightly adjust the ratio. And if we have new elections, we believe that some investor can decide to slightly rebalance from OAT to BTP. And in this case, this is an environment where we can see further pressure on the OAT bond. And that's the reason why, if we have new elections, we will see 100 pips, I think. This is perfectly reasonable. But yeah, that's really something that we need to monitor, is the foreign holders, Japanese, or also Asian investors.
Nicolas, great to catch up. Thanks for the insight and the analysis. We really appreciate it. Nicolas Faure, CIO of Candriam. Coming up, we're going to be talking about what is happening in the tech space. There's some interesting commentary coming out of the United States relating to China right now. We've also got the story that ASML is reportedly set to become the top shareholder in Mistral AI. We'll talk about that stock. We'll talk about other stocks. There's plenty of stocks to watch this Monday morning, and we'll talk about them next. 19 minutes to the market open. This is Bloomberg. Let's call it 16 minutes to the market open here in Europe. This is what futures look like. A fairly positive picture, probably more to do with what else is happening kind of around the world to what is happening maybe here in Europe, because we're firmly focused on France this morning here in Europe. Just been talking about it. Let's carry on the conversation. Peter Kinsella, Global Head of Forex Strategy at Union Bank Privé, joining us around the table. The debate we were having just a moment ago, let's kick it off. Sure. If France was downgraded, would there be a reaction in the euro?
I don't think so.
Why not?
I think it's largely, excuse me, I think it's largely priced in, right? I think I'm surprised they haven't been downgraded already, but broadly speaking, the market anticipates it. And if we look at euro dollar, in the last, 2 or 3 weeks since we've had this massive spread widening, euro basically hasn't been affected at all, right? And I think the assumption really in the market is that they believe that the ECB will step in to cap spreads if we see a really
rescue France. So Lagarde's going to rescue France. Rescue Macron.
I would say it's the ECB doing it rather than Lagarde. But I think that's really sort of what the markets are betting on, and I think that is a correct assumption.
Okay, and in the other little debate we were having just as you sat down was, would France take any kind of imposed action? Say the ECB went, yeah, we're going to cap spreads, but you've got to sort your budget out. Do you think the French could take that?
Well, the process we have is that Brussels will engage or activate the excessive deficit procedure.
Yeah.
And that's if the French cannot form another government and cannot come up with a credible plan to correct their finances. So there's still another act before we get to that stage. So we'll have to see how that goes. But I think, look, it's pretty clear the government is likely to fall today vis-à-vis a motion no confidence, broadly expected. It'll have no effect on euro dollar whatsoever, again, because we all kind of think and know that the ECB will...
I'm glad you're here.
But Peter, walk us through the kind of timeline of an ECB intervention. What kind of level would we have to get to outright on OATs or in the French Bund spread in order to, get the ECB to do something about it?
Okay. I think if OAT bunds go well north of 100 bips, that's going to, I would say, set the cat amongst the pigeons, as it were. So I think you'd have to see a spread widening in excess of 100, 120 bips. At that point, then they'll talk about it. You'll likely see some comments from the ECB, various ECB members. And then at that point, then we'll have to see what they actually do. But you're not going to get just outright, bond buying. You're going to see some form of conditionality, and that's how it's worked before.
Yeah, conditionality.
But I don't think we're there yet. I think
How is Lagarde going to answer these questions on Thursday? She's giving a press conference right after their rate decision. Not a lot of jazz expected in the actual decision, but this could really be where the drama is. How she fields these questions on the French situation,
especially because she's French.
Indeed, indeed. Look, I think she'll downplay it as much as she can, right? That's what I would do if I were in her situation. I would simply downplay it, wait for the politics to ease itself out, see where we go, and essentially she'll just say, look, we're watching it. End of, right? But again, I don't think it's going to have significant implication for the euro at this stage.
Okay, so no more than she's already said, basically.
Correct.
Let's talk about Japanese politics. We've been discussing the potential runners and riders. Yeah. Some want, looser fiscal policy, looser monetary policy as well. How much further could the yen fall if you get the first female prime minister in Japan?
It's not a question of falling. I think it's already very weak, right? But I think the issue here is that the BOJ is sending very mixed signals. And on top of that, we've also seen very mixed data from Japan, where we've had several months of sort of, negative real labour cash earnings. Obviously, we saw last week's print, which was okay. And in a sense, if we look at what's priced in for the BOJ, barely one rate cut this year, right, if even. And if you look at the two-year swap, it's trading at roughly 30 bips above where we are today. So it really points towards an incredibly easy and non-aggressive rate hiking cycle from the BOJ at best. So that really tells me from here, we're not going to see any idiosyncratic catalysts for yen appreciation. Okay, it's really all about the dollar leg vis-a-vis dollar yen. And that really tells me, dollar yen at 149, 150, that's kind of roughly where it's going to top out, I think. I don't see it going a lot higher.
So you take me to the US. We've had payrolls. We look ahead to CPI. What sort of print would have you bracing for a 50 basis point cut from the Fed?
All right. Well, I think there's a couple of points. If we look at US labour market data, last week we got JOLTS data, which has basically shown that sort of large decline in open vacancies. If we look at the NFP data, it's telling us that the labour market has basically reached stall speed, right? And so we priced in 25 for September, about a 15% pricing for a 50 bip rate cut. If we get a significant negative surprise, as in well below expectations on the CPI print, then you're going to price a bit more towards 50. I think that's unlikely. So, my base case is 25, but with a risk of 50.
Why does the Fed need to cut rates at this point? The labour market is okay, 4.3 unemployment. That looks okay. Yes, you've got negative NFPs, and you could argue that's down to immigration. Credit expansion is epic at the moment. Financial conditions are super loose. Stock market's at record highs. Does this scream an economy that needs a 50 basis point cut?
Vis-a-vis the labour market, I would say that unemployment is normally a lagging indicator, right? And so the issue is, it's where is the economy going to be? And we do know that it's likely to slow from a growth perspective into the second half of the year. So they're a little bit tight. I think that's pretty clear. We're going to see a bump in inflation on tariffs. Thereafter, it should decline somewhat. So if we're looking forward, if we listen to the Fed and what they're saying, they're basically saying that inflation, they're kind of happy with it. Their confidence is going to come off. Labour market, they are concerned about. And in that context, some... It's
4.3, a high number.
I wouldn't say it's high. It's definitely low from a historical context. But they don't necessarily want it to go higher, right? So I can see them cutting. I think there are reasons to cut rates,
50 or 25?
I think they'll do 25, but with a risk of 50.
Peter, when you look at the mix of Donald Trump's policies and what effect they could have on the U.S. economy, there seems to be a huge debate on what the effect of these immigration policies will be. Is that a key focus, and does that, I guess, underpin your view on the U.S. economy?
It doesn't that much, if I'm frank, because what we see in the US is a pretty heightened degree of policy uncertainty. Right, one day it's X and the next day it's Y. So vis-a-vis the immigration, look, we'll just have to see how it goes. It's going to create labour market pressures within labour-intensive industries, right? So in construction, for example, and so on. So you're definitely going to see evidence of wage growth there, and stickiness in particular. But overall, it's not something that I'm looking at. It's not a big factor in what we're looking at present, although it is a concern, clearly.
OK. Peter, nice to see you.
Thank you so much.
Kinsella, Global Head of Forex Strategy at UBPS. Now let's get to your stocks to watch with Chloe Melly. Chloe.
Good morning, Lizzie. Let's start by keeping an eye on gold miners today. That is after Trump exempted gold as well as some other key metals from global tariffs. So we should keep an eye on a company like Rio Tinto, which is one of the biggest names in that sector and has been having quite an uneven performance, as we can see here. Other names to keep in mind would be companies like Fresnillo, Oshtown Mining, also other companies listed in the UK, slightly smaller gold miners. What's also worth keeping in mind is that this could potentially pave the way towards more exemptions. So let's keep an eye on that. Moving on to recruiters, UK recruiters, there is some new data that UK wages for new hires are growing at the slowest pace since March 2021. So let's keep an eye on Page Group, Robert Walters and Hayes. All of them have been having quite a tough year already. So let's keep an eye on that this morning. Moving on to ASML, which is taking a 1.3 billion stake in Mistral AI, an AI company based in France. It's a company that is competing with the likes of Google and OpenAI, and so this could potentially provide a bit of a lift in the shares this morning, because it's already been down a little bit over the last 12 months, so it could provide some much-needed relief for ASML.
All right, thanks to our equities reporter Chloe Melly on the stocks to watch. Just a few minutes ago until the market opened, 7 minutes ago, in fact, I thought it was pertinent to end there on ASML because we've had another round of news, I guess, on the chip sector. We also have the U.S. weighing annual chip supply permits for Samsung and Hynix. Kind of just this overarching theme that Trump is not done
it's day after
when
day.
It comes to these chip tariffs.
Yeah, every day there seems to be more narrative coming out of the White House, be it from Trump or from others, on what is happening in the chip sector. Clearly they are not done. Clearly there is further tightness coming. Clearly they're watching what's happening in China quite carefully at the moment. The Chinese are trying to push on with their own objectives in terms of making themselves independent, but clearly aren't there yet. So, yeah, it's interesting that there's so much volatility in this. I don't know how you price it. Given that it is changing, if you're Samsung or Hynix, how do you price this? What impact is this going to have? How does this impact ASML? Because they are obviously a factor in this story as well. But it does seem as if the narrative is changing quite quickly. If I was a CEO of one of these companies, you'd be really struggling at this point to know what to do next.
Yeah, but it's interesting to see the European story getting a boost from ASML. You know, the two coming together. But, you know, we're looking for someone to lead European AI in a way that can compete on the global stage. And, yes, there's so much hope that we will have our own NVIDIA or whatever, that we will have our own horse in the race, but this giving a decent push to Mistral.
Absolutely. And it's interesting, the overlaps that are coming. What does ASML get out of it? Is this just a financial investment? Is this just a we see this as a
they get a board seat out of it?
Yeah. but is there if you're a lithography company, you're quite a long way away from an AI company in terms of the way that the supply chains work. So why are they doing this? Is it simply just they want to back a European champion? I don't know. But it's not as obvious a case to be made in terms of some of the other more vertical integration. Anyway, the opening trade is next. 5 minutes to go. This is Bloomberg. Monday morning, good morning. I hope you had a great weekend. If it was so great that you can't remember what Friday looked like, let me just remind you as to what we saw Friday. And it was obviously a day we saw the payroll data dropping. It was weak. Much weaker than maybe people had anticipated. Despite that, though, the unemployment rate reasonably stable at this point in time. The initial reaction in the first couple of minutes was actually stocks went higher, then they dropped, and that's the drop you can see there. We did pick up off the lows, but in some ways it was a cautious equity market that maybe came out of the Friday session. This morning we're looking a little bit more positive, but kind of where do we go next from here? What signals should we be taking from the economy, particularly in a week when we are watching what is happening with the inflation picture? Val, futures at the moment, though, still fairly positive.
Fairly positive across Europe. Eurostoxx 50 futures up 0.6% to start this Monday morning. FTSE 100 futures not far behind, up 0.3%. The CAC 40, these futures are up 0.5%. Remember, we have that vote of confidence to take place in France later tonight. Seems not to be able to dent this equity market rally on this Monday morning. Lizzie.
Well, I'm keeping an eye on Amsterdam because we need to keep an eye on ASML. We know that it's going to become a top Mistral holder. 1.3 billion euros is the value of this deal reported by Reuters. So watch those shares. We also keep an eye on the oil majors after we had another supply hike from OPEC Plus over the weekend, but only a modest one, hence the moves that we've seen in oil. 137,000 barrels a day extra. It was just an 11-minute meeting, so it didn't take long to decide on that. And finally, as Chloe Melly was highlighting for us, we watched the UK recruiters after the latest data from the Recruitment and Employment Confederation. Wages for new hires in the UK rising at their weakest pace in over 4 years. So that's what I've got on my mind. Guy, let's go to the open.
OK, let's talk about some numbers. Let's give you the opening trade. It is time for that this Monday morning. Let's see what happens. Kind of first full week that we've had, you could argue, for quite some time. But the FTSE 100 not doing much at the open as anticipated. We are expecting a more positive picture to emerge across Europe. We do have a little bit of a legacy coming through from Friday that we need to factor into our thinking as well. So the stock 600 is up by 0.2%. Keep an eye on oil stocks, keep an eye on the oil majors, but also keep an eye on the miners as well. And that's all going to be factored into the FTSE 100 this morning. There's a few single stocks that we need to be watching out for as well. We were mentioning just what was happening with ASML. We'll see what the reaction is to the Mistral news on that. But the CAC 40, interestingly enough, is the outperformer this morning. Not the laggard, the outperformer, as we approach the ousting of another French government a little later on this afternoon. But it's interesting to see that French stocks are on the front foot this morning. We'll wait for the DAX, we'll wait for the SMI. We'll see what's happening there in just a moment. Val, what do you got from the sector point of view?
Well, from the sector point of view, we have all but two in the green so far in the first few moments of trade. At the top of the basket, no surprise, is energy. That sector up around 1% to start today's trade. Technology not so far behind. That sector's up 0.6% due to gains in ASML. That share is up just less than 1% in the first moments of trade. At the bottom of the basket, we have travel and leisure and telecom. So it does seem to be kind of a normal risk-on day when it comes to these markets here in Europe. We have 407 stocks in the green, only 92 in the red across Europe this morning.
Yeah, so just diving into energy, so you've got BP up 1.4%, Repsol 1.3%, about the same for Shell, Total not far behind. So all of those in the green off the back of the oil moves. You mentioned ASML, those shares up 0.9% at this moment. And we were discussing the UK recruiters, just zooming out to the broader index. The FTSE up 0.25%, about the same move for the FTSE 250, but it's green across the screen for European equities. And as you say, Guy, that probably comes back to the macro picture when we look at the US futures moves as well.
It's interesting. French stocks are up, and you can see why. Airbus is having a good day this morning in terms of points. Total is up. It's having a good day in terms of points. Schneider's up. The company so associated with the build-out, the AI build-out, it's up quite nicely. Sanofi's trading. None of these companies are directly related to really what happens in France. They are global stocks that are maybe being buffeted more by what's happening on the global picture rather than what's happening with the French picture. But it's interesting to see the outperformance coming through from France. But it's not necessarily French-related, I would argue, in terms of what we are seeing.
Yeah, but it kind of chimes with what we heard from our last guest, that even the euro hasn't really been reacting to the French political crisis. We'll keep an eye on how that delves out with the vote to take place later tonight. So this could be more of tomorrow's market news in terms of the French political instability. But let's broaden this out to the bigger macro picture. Joining us now across the table is Nancy Curtin, the CIO at AITI Tiedemann Global. Thank you for joining us this morning, Nancy. I read that you're still positive on U.S. stocks, but what did you make of the Friday payroll report and all the revisions that we've gotten?
Well, first of all, it was decidedly weak, that's for sure, at 22K. But I think we have to remember that the break-even job creation rate is coming down from the crazy numbers we had, in the last couple of years. Whether it's 60 or 70K remains to be seen. So in that context, it probably didn't look too bad. When you looked and parsed through the data, where was the weakness? Government sector, DOGE, probably the tariff impact, manufacturing, wholesale trade. Maybe the worst is behind us. Construction, the Fed easing will help that. So we have a sense that this is a weak patch, absolutely could continue. We'll keep an eye on it. But as we head towards 2026, we do think an increase in CapEx and investment spend, which tends to correlate to job creation, could be the sort of antidote to the weakness that we're currently seeing. And remember, the unemployment rate, 4.3, is within the FOMC's definition of full employment.
Well, Nancy, I guess the one thing that could hamper the equity market rally is a return of fiscal worries that we're starting to see glimpses of, at least here in Europe. The UK last week, we have our eye on France. Look what happened in Japan over the weekend. Is that something you're concerned about? And would there be a catalyst that could arise that maybe would knock your enthusiasm for U.S. assets?
So, look, we're dropping prime ministers like flies here. Another one today. And I think the picture in France, in Japan and UK is a picture that's more challenging. Obviously, they have very high debt levels like the United States. The option to grow out of that debt is less clear, right? So just pursuing austerity, which obviously the populists don't think is a good idea, they're very, very challenged in getting those things. We need more structural reform, deregulation, et cetera. So I think there is pressure on long end of bond markets, and that could be the United States. Having said that, we need to look to see whether the U.S. experiences kind of a 1990s playbook, which is an improvement in productivity. Remember, that brought GDP higher in the United States in the late 1990s. It brought inflation lower. And actually, the debt and deficit levels improved as a result of surging tax receipts. So it's one of the things we're watching. And remember, in the second quarter, Productivity in the United States came in at 3.3%, a pretty strong number.
Well, could one of those catalysts be these legal hurdles that Trump's tariffs have to clear? Because, of course, the consequence could be he doesn't have enough money to cut taxes as much as he'd like and not, therefore, able to boost the economy as much as you expect.
Well, great question, because the income coming in from the tariffs is running about $25–30 billion a month, money created out of nowhere, in a way. Now, the legal challenges, it's going to go to the Supreme Court. We probably won't know until next year. There's a conservative majority. And by the way, there's about 4 or 5 other statutes that Trump has at his disposal to use, Section 232 by way of example. So, look, we think tariffs are going to be a feature of the Trump administration no matter what happens on IEP. There is a legal challenge. I have a feeling he'll get through it, but we'll have to see. It goes to the Supreme Court next.
So basically, don't worry about that for now. Just coming back to the jobs market, are we kind of in a Goldilocks moment then? Is it enough to justify 50 basis points, the weakness in the labour market?
I don't think so. I think the Fed, and we heard from Goolsbee last week on Bloomberg, there are too many conflicts. You've got full employment, you've got a softer jobs market, but you don't see firings, you don't see unemployment rising too dramatically. It's a confusing picture. Our sense this is a mid-cycle slowdown, or whatever we want to call it, temporary on the jobs market. As I said, as we look forward to 2026, given what we think will be an investment spending boom, or at least increase, and we already saw it in the second quarter numbers, that tends to be highly correlated with job creation. So this may be a slump with 2026 beginning to get those jobs back again. And by the way, freeing up workers from the government sector to work in the private sector, no bad thing for an economy.
Well, do we need them in the manufacturing sector? I think that's one sector that shed a lot of jobs recently, Guy.
Can you go from the government to the manufacturing sector? That seems like quite a jump to do quite quickly.
The U.S. economy and workers pretty flexible. Where there's a job, there's a person. So, I find the economy very, very flexible in that regard.
Credit creation is epic at the moment in the United States. Why do we need cheaper cost of money?
I think there are parts of the economy, housing, that has not experienced any rebound. Lower income consumers are still weighed down by credit card debt, et cetera, and they pay quite high interest rates on that. Manufacturing side has still been in, broadly contractionary territory. Small businesses still impacted. So I do think, given where we are, by the way, unit labor costs are actually quite good, given my productivity comment. I think the Fed could loosen up a bit here, and I think it will help the other parts of the economy which have struggled. So, yes, but we have to be careful. We don't have too much easing, and we end up with too much growth as we go forward to next year. So it's a tricky situation. But I think full-on, spot-on for a rate cut next week. I think that will happen, 25 basis points.
Would cutting aggressively with stock markets at record highs be a good idea? Just put those two things together for me.
Watch the bond market. That's the guardrail. Yeah. That's the long end of the bond market. So we've been positive on equities, U.S. equities in particular. Look, I mean,
but you're watching the bond market.
But we're also actually quite short duration on bonds.
But what signal would you need to take from the bond market to worry you about?
A 10-year, 30-year continuing to move higher. I mean, actually move lower. 4.5, 5 becomes the red line a bit for equities. So we're going to continue to watch that. But I think that's the guardrail, because what happens with that guardrail is you get a policy shift. Right, you'll have less interest rate cuts, et cetera, et cetera.
Well, I guess you have to add in the whole Fed independence, the musical chairs going on at the Fed into that conversation, because that could be definitely something that could freak out the bond market in terms of them pricing in too much easing into the front end. But we did hear from Trump over the weekend, or late on Friday, I think it was, that he said that it was still Kevin Hassett, Kevin Warsh, and Christopher Waller in the running. Yeah. No wild card has made their way into the final three, it seems. Does that give you more comfort that we wouldn't have too much Fed easing coming to fruition?
Look, I think the two Kevins are sensible picks. I don't think these are crazy, appointees. Certainly, they probably are towards easing, that's for sure. Putting that aside, if we look at the challenge to Fed independence, that is concerning. And, if Trump manages to get a majority of the Board of Governors, they have the ability to appoint the regional bank presidents, right? And remember, all 12 are up for reappointment next year. So I think that is what markets will be watching. But, you know, again, a guardrail, as we saw during the tariffs, and Scott Bessent well aware of it, when the long end of the bond market starts to freak out, that's when Trump has pulled back.
What would cause that to happen? We talked about Fed independence. That's clearly a challenge at the moment. You've got a tariff story that potentially could drive inflation higher. You've got a labour market that's weakening, but as the labour market's been weakening, we've still got quite strong inflation. What would cause the bond market to deliver that shock that you think could cause equities to kind of take another look?
I think if you begin to see persistent goods inflation, which our own view is it's likely to be one-off. We'll see we've got a CPI and a PPI number coming up this week, but also services inflation. Remember, super core services are actually disinflationary. If you take out, you know, the sort of rent is a very, very lagging indicator. Super core services were actually down in the month of July, 85 basis points. Goods were up, so we're going to have to see that mix as we look forward to the upcoming, CPI print this week. But obviously, service inflation and goods inflation at the same time, that would be a concern, that inflation becomes more persistent as opposed to one time. So again, it's all in the long end of the bond market. That's the signal. That's what you have to watch. But remember, you know, from an equity perspective, earnings have been fantastic, right? 12% in the second quarter, expectations of 4.9. I reckon third and fourth quarter will also be.
That sounds like an economy that needs rate cuts.
Well, again, I think we have to be careful here. I agree. You know, Trump has called for 3% rate cuts. I mean, that kind of stuff is crazy. But then he always has the most extreme. Maybe we'll get 75 basis points to 1%.
Nice to see you, Nancy. Always a pleasure.
Likewise.
Thank you
Great to see you guys.
Nancy Curtin, CIO at Alti Tiedemann Global. Let's talk about what we're seeing in the market this morning. Fairly strong bid coming back into European equities, so we'll keep an eye on what is happening there. You can see it certainly within the tech sector. ASML is up. Schneider's having a fairly good session. Luxury also on the front foot. Defence names are back. The more staid end of the market, the more stable end of the market. Nestle, a little softer this morning. Novo, certainly a little softer this morning. What are we watching? Oil front and centre as well. We haven't talked about that. Chloe Melly's here to do just that, though.
Good morning, guys. Yeah, let's start with oil majors this morning. They are moving a little bit higher on the back of that OPEC production hike, although it's quite a modest hike, and that explains maybe the slightly modest gains. But we have that wall of green across Shell, BP, Repsol and Eni this morning. Moving on to Ryanair. Ryanair is down this morning on the back of a downgrade. So it was downgraded to a neutral rating at Goldman. It comes after flagging quite a cautious outlook this summer, and also after Jet2's profit warning last week. So maybe it signals a little bit of weakness in that UK low-cost airline kind of space. Moving on to M&S, another UK stock, but this time it is an upgrade. It was upgraded at Citi. Obviously, M&S had the massive cyber attack that it dealt with and that paralyzed its operations for months. But now it is apparently turning a corner, and therefore we have shares up this morning on the back of that Citi upgrade. And finally, let's end on another UK stock, quite a UK-heavy day this morning. Shares are down for Phoenix Group. Phoenix is an insurance company. Profit actually did beat estimates, but perhaps investors are reacting to its name change. So it's changing its name to Standard Life from March 2026, and perhaps investors don't like that name very much. Perhaps some other numbers also disappointed a little bit. So it is down almost 5% for Phoenix this morning.
OK, Chloe Melly from our equities team, thank you so much for those movers at the open. Guy, we've been talking a lot about politics this morning. We've been talking about Japan, the French situation, the UK on Friday, but we've also got to keep an eye on Norway.
I'm going to take you to Norway right now. There's a sort of slightly moving but live shot coming out of Norway as we... this is it. There you go. This is kind of as it's happening in Norway. The election is underway. You could argue that Norway is a sovereign wealth fund with a country attached. It kind of has a disproportionate impact as a result of its wealth and that fund, which obviously bleeds into stories like Israel and what is happening there in terms of the idea that we should be disinvesting, or the Norwegians should be disinvesting from Israeli companies. That's been a story over the last few days. It's also the Nobel Peace Prize coming up over the next few days. Trump wants it.
He's had a few calls.
What happens if he doesn't get it? What happens if Trump doesn't get the Peace Prize? Does he direct his ire towards Norway and the next government that is going to be formed in Norway?
Well, the finance minister who reportedly got that call, I'm sure we'll find out. We're coming up on the programme. OPEC Plus pushing its bold strategy a little bit further with another oil production boost. We'll get you the details next. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 18 minutes into the equity market session, 19 minutes, and actually reasonably positive. I'm not sure there's a direct line you can draw between kind of French performance this morning and what is happening in French politics. It's actually names like Airbus and Schneider that are trading strongly this morning. Total is also having a good morning within the oil trade, and that is maybe providing the updraft that we're seeing in the French market. But by and large, it feels like a stock story this morning rather than a geopolitics story that's bleeding and pushing into that narrative for European equity markets.
Yeah, it's the international names that are leading the gains, and it is just a wait-and-see moment for what happens in the weeks and months when it comes to France. But as you say, oil, energy, the best-performing sector on the Stock 600 this morning, oil itself climbing, and this comes back to OPEC Plus agreeing to raise production once again, but at a modest rate, and it highlights really the caution from some of the group as the market heads into this unexpected surplus. Now, the group says that it's going to restart 137,000 barrels a day of output. It defies the warnings from Wall Street that the move risks compounding a supply glut. And joining us now for more is Bloomberg reporter Anthony Di Paola. Anthony, good morning. Look, we know that OPEC's given up defending oil prices. They're going after market share here, but not everyone has the capacity to benefit from this. Which are the names, which are the countries that are going to be able to pump more now?
Good morning, Lizzy. I think it's pretty much Saudi Arabia that's been pushing these increases and really driving the OPEC Plus group to add production, rolling back these cuts. And it's going to be the Saudis that have the most spare capacity and are being able to bring back the most oil. Also, other Gulf producers, we've seen the UAE with some spare capacity as they also are increasing the amount of oil that they can produce. Kuwait's also got some spare capacity, and Iraq wants to produce more. Iraq has been producing over their quota as well, and they are continuing to be in talks with the northern Kurdish region there about getting production exported from that region. It's been halted for over 2 years now. So it's really some of those Gulf countries, and of course, Russia will also try to produce some more, but we're also seeing some potential moves around sanctions and around efforts to restrict oil there. But some of those other OPEC Plus producers will have difficulty bringing barrels back onto the market. At the same time, OPEC Plus is going to be competing with barrels from the Americas, from the U.S., Guyana, Brazil, those non-OPEC Plus countries that are bringing more oil on. And that's the influx in the market that's possibly creating the risk of higher stockpiles and lower prices later this year, Lizzy.
Anthony, you mentioned just there that sanctions are still weighing over the oil market. The EU actually weighing new sanctions on Russia, the 19th package since Moscow's full-scale invasion of Ukraine. They want to hit energy companies. What do we know about this?
That's right, Valerie. Yeah, they are looking at this, as you said, this 19th package, and it depends really on where they try to focus on that. We've seen some of the most effective sanctions being around shipping and insurance that have driven out some of the vessels out from being able to do kind of a legitimate trade if some of those vessels go beyond the European Union price cap. There has been talk about trying to lower that price cap, but that's never come to fruition yet. And some of the Europeans are saying that they would like the U.S. to come along. We have heard some comments from the U.S. Treasury Secretary that they want to do more on Russia. But that's been the real piece that's been lacking. Donald Trump has threatened to put more sanctions on Russia if it doesn't come to the table, if it doesn't agree to a ceasefire. But so far, we haven't seen the U.S. really tightening up the constraints on Russian oil production. Of course, that's probably a resistance to increasing the oil price and also wanting to keep the relations with Moscow good. So we'll see what the U.S. piece is of those sanctions when we get those, Valerie.
Anthony, just to come back to kind of where we are now versus where we were, is there the same amount of Russian crude on the market now as when we put the first round of sanctions on Russia? Has anything materially changed given the amount of crude that the world was taking from Russia? And do you get any sense that the European Union would be prepared to back secondary sanctions? That feels like a big step in terms of places like India.
Yeah, Guy. I mean, we have seen some material changes in the market. The oil market adjusts and flows move around to different places where they can get to. So when there's an obstruction, be it a closure of a strait or a port or financial sanctions, the oil market works around to get oil to where it needs to be. The big change that we've seen has been the products going into Europe. So Europe's not taking diesel from Russia anymore. Europe is in a short position for diesel. And so there we've seen the Europeans taking a lot of diesel from India, which has been buying that Russian crude. So, of course, if the Europeans or the U.S., for that matter, the U.S. has already put 50% tariffs on India because of its purchases of Russian oil, we haven't seen the same level of pressure on China to stop its purchases. But the more you pressure those countries that are very strong in the refining business, the more you put pressure on them to stop buying Russian oil, that will filter through into the product market. As I said, Europe is already short of diesel, needing to import from other countries to replace what it's been getting from Russia. Of course, the Europeans are not buying crude anymore. Gas has stopped. A lot of that gas is going to China now. Crude is going around to India, to China. So the more pressure you put on those points, the more you try to cut that off. One, the oil flows will adjust and try to find a way to get to market. And two, you'll see those increasing prices coming more downstream in the refined products.
Anthony, thanks for the update. Really appreciate it. Anthony Paolo joining us on what is happening in the oil market. Let's talk about what is happening in the foreign exchange market. The yen now nearly at session lows as we mark a turbulent picture in the Japanese political scene. Paul Dobson joins us now. Nice to see him in London. Ishiba's gone. The yen is down. If we get political turbulence over the next couple of months, though, how much further could we see Japanese assets being undermined?
Yeah, so I think what's crucial is to look at those long-end government bond yields and what's happening there and whether demand will resurface. We've seen another push up. People are worried that the government is going to need to spend more in order to secure kind of popular support, and that obviously weighs on Japan's already very high debt load. And investors are expressing that by kind of piling out of the back end of the yield curve, and the call buyers haven't yet resurfaced. So each time we see that sort of increase in yield, we see more pressure on the currency as a result as well, and that kind of, is pushing us back towards the 150 level. Beyond that, there's some support, but beyond that, could be quite a lot further. Flip side is that the dollar is also under pressure, of course, because of what the Fed is up to, and so that kind of balances things to a certain extent.
OK. Paul, nice to see you. Thanks for stopping by to see us. Nice to see you in London. Paul Dobson, Bloomberg's executive editor for Asian markets, coming to London as we see a tube strike, making things a little bit more complicated. We did that, yeah, precisely. We're going to turn things over to what is happening in France next. The likelihood is that we're going to see the Bayrou government being ousted a little bit later on today. We'll turn our attention to what is happening in French politics. That's next. This is Bloomberg.
Welcome back to the opening trade. We're 30 minutes into today's session. If you're just joining us, maybe you're not joining us from your desk because there is a tube strike here in London. Hence, perhaps we have lower trading volumes. Hence, perhaps why we have the FTSE 100, the underperformer across Europe this morning. It's a sea of green, but the outperformer this morning is the DAX. Thanks to the boost to defence names, you've also got, perhaps surprisingly, given the French turmoil in politics, outperformance here for the CAC 40. But it's more the international names. You've also got a boost to the likes of Total Energy coming off the oil story, but across the stock 600, Guy, we're 0.3% up at this point in the open.
You could argue there's some action in equities this morning. Not much action, but there is some action. Let me just show you what is going on in terms of the internals. 353 up, 223 down. I'm not sure there's a massive signal there. London's lagging because of names like Astra. Volume is, though, light. Like, it's been light for a while, but volume is definitely light this morning, and I do wonder, to Lizzy's point, whether or not that is related to what we are seeing in terms of the transport situation here in London with the tube strike that is on. I want to flag as well what is going on in the commodity story, less to do with what is happening with oil, but more to do with what is happening in gold. Gold, another fresh record high this morning. Take a look at the chart. You'll see it there once again. Who is a beneficiary of that? Fresnillo is a beneficiary of that. This stock just continues to rocket higher. I keep bringing it up as a 52-week high. There aren't many 52-week highs out there this morning. There are no lows that I've tracked so far this morning on the stock 600. But Fresnillo continues to stand out as a 52-week high. The stock is now up 323%, 324% on a 52-week basis. And the gold price just continues to power ever upwards. And this is the derivative trade of that, Valerie.
Well, here's what else you need to know this morning. Japanese Prime Minister Ishiba says he'll step down to give way to his successor following weeks of calls for his departure. The move has sent the yen lower and stocks higher in Tokyo and further adds to the risks weighing on the long end of the Japanese bond curve. Oil has been pushed higher today on reports the European Union is exploring new sanctions on about half a dozen Russian banks and energy companies. Sources say the bloc is hoping to coordinate some of the latest measures with the U.S. A delegation of EU's officials are said to be heading to Washington this week to discuss a potential for joint action. And lastly, French Prime Minister Francois Bayrou's government is expected to fall today. Bayrou's coalition will face a confidence vote in France's lower house, a motion he called for in a bid to pressure lawmakers to back his budget-cutting proposals. Guy.
Valerie, let's pick up on that story. It looks like Bayrou's going to go, but what happens next? Let's try and answer that question. I want to take you to Paris. Caroline Conan is at the French National Assembly. Caroline.
And I'm actually with a guest who is from a party that is key to today's vote, the Socialist Party. Arthur Delaporte, a Socialist MP since 2022, the last time that Macron was elected. Is there any way that today we're not going to see Francois Bayrou fall, or is that a done deal?
I'm sorry to say that today is the last day of Francois Bayrou's office, and I think it's Francois Bayrou's fault and only fault, because during the summer he never tried to reach any agreement on a budget, and we always said that it was unacceptable for us, and he never tried to call us, and that's, I think, a problem, Francois Bayrou's fault, but also a democratic problem.
What is next? Your party wants the Prime Minister seat.
Yeah.
You think we're going to have, over the next couple of days, quick and fast decision from President Macron and naming of a socialist prime minister?
I'm not in Macron's head, but I can say that our position is that a socialist or someone from the left is appointed as prime minister, because we think that we tried twice a minority right-wing government that never managed to reach a non-censor agreement, and today we say that socialists and the left, without the France Insoumise, would be able to have a majority in parliament, not to be pushed away, not to be censored, and that we think a different method can enable us to be in office, but also to reach compromises in parliament. We said with Olivier Faure that we would renounce to the use of what we call the 49.3, 49.3. It's an article of the Constitution which allows the government to pass a bill without a vote in parliament. But then the government can fall, and that's what Michel Barnier did, and he fought.
But obviously Olivier Faure is raising eyebrows, notably from some of the centre-right. Do you believe the socialists would support a sort of technocratic left-wing figure, such as Éric Lombard, the current finance minister, or Pierre Moscovici, for example, the Cour des Comptes president? Is that the way to go?
What we say, if we want stability, we have to have a kind of political alternative. And that's why we cannot have, for instance, I think, Eric Lombard, because Eric Lombard is responsible of the past budget and one that was presented this summer and that will make François Bayrou's fall. So if we want an alternative, we have to have a sustainable alternative, but also to show that the French people have a new government and not a kind of continuation of the Macronism. Because if we have a new Macronist government, even if with the support of the socialists, then it might still fall.
But of course, the socialists have presented already an alternative budget that includes 22 billion euros of savings, half of what François Bayrou was proposing. You're also delaying the return to a 3% deficit target to 2032 rather than 2029. Don't you think that your socialist program, your socialist budget is actually scaring investors?
I don't say that, because what scares investors is instability. And today, if we have a sustainable trajectory for debt reduction, then we can have sustainability and social acceptance. And that's the key, because if you make, for instance, a kind of plan with 44 billion of cuttings, then you won't have 44 billion of cuttings because you won't have any budget. So if you want a sustainable budget, you have to make choices, and to make choices that are accepted by citizens. Today, we see that citizens are more and more angry against governments. And if we have, for instance, millions of people in the streets tomorrow, we'll say that what we can do is always spending more. For instance, in 2089, you had the Gilets jaunes crisis, and the government has to spend 10 billions to make this
Are we seeing a new yellow vest potential crisis next week and September 10 with this social anger, all these protests?
I cannot say if we will have this, because maybe François Bayrou's fall will make this kind of crisis smoother. But what we know is that if you have a social crisis, it costs more than maybe 5 fake cuts in 5 billion cuts in budget. So.
Let me quote two of your proposals from your socialist budget. One proposal is to cancel the retirement reform, come back to a retirement age of 62. Another proposal is the so-called Zuckman tax, which is taxing 2% of those with a wealth of more than 100 million euros. Those two proposals are a no-go for Macron's camp. If you want to get any stability, if you want to get any majority in parliament, you'll have to get rid of at least these two proposals. Today, are you telling me the Socialist Party is ready to get rid of these two proposals?
What we say, if we have a new government, we have to make some proposals that are accepted by people. Today, Zuckman tax is only for 1,800 people. So it's a very small amount of persons.
The opposition says it's confiscatory. So
no, because today this person had a wealth progressing of 10% each year. So if you take only 2%, it's 1/5 of this growth of wealth for the richest people. It's not so much, because today you are taking on poorest people, and this is also very recessive decision.
But this is a no-go for Macron's camp. Are you getting rid of this?
With this decision, is creating also recession, because if you take the money from the poorest, then they do not consume, and it's always scary for markets too. So you have to make choices and
what about the retirement
justice.
reform, really quickly? Are you ready to get rid of this?
The retirement reform is only a suspension of the reform. So we stop the reform at the time it is today. It's not going back to 62, but it's saying that we have to launch new social discussions with an aim of 62, but with also new fundings for this reform.
Arthur Delaporte, Socialist MP, thank you so much. He's saying that a Socialist Prime Minister could potentially bring stability to France. Let's see.
OK, Caroline, thank you so much for bringing us that conversation out of Paris as we head towards that confidence vote in Prime Minister Francois Bayrou later. It's definitely a question that's going to come up at the ECB's meeting this week to Madame Lagarde, of course. We'll be watching that rate decision on Thursday. They are due to hold, and ahead of that, we're going to be speaking to Jens Eichenschmidt on this programme, Chief Europe Economist at Morgan Stanley. That's next. This is Bloomberg.
43 minutes past the hour. Welcome back. You're watching the opening trade. This is the state of play for European equities. Volume is actually quite light. You are seeing some outperformance, though, coming from the German market. Some of that has to do with what we're seeing within the auto sector. Volkswagen is currently trading up 0.4%. The Munich Motor Show is on. Automakers very much showcasing their latest models. Of course, they're addressing some of the challenges they're facing, including what is happening with tariffs and China and technology. And, well, there's lots of things that we need to be thinking about. On that note, Stefan Nicola from Bloomberg spoke to the Volkswagen CEO, Oliver Blume. He asked him about his view on what is happening with the current trade discussions.
We welcome the joint agreement between US and EU with the opportunity to come to a signed agreement retroactive from the 1st of August on. And that gives us planning security. On the other side, the 15% would be a burden for Volkswagen Group. That's very clear, and we don't appreciate the asymmetric deal in between US and EU because it's distorting the competition in Europe. And therefore, we are counting on our own offer, investing heavily in the US, linked to our growth plan we planned in the US. And there we are in close contact and good talks with the US government. And we hope that we come to a quick solution also during the next weeks with the support from the US government to our investments, because we think that's very attractive for the US community, building employment, building a supply chain, and that at the end gaining taxes in the US. And that is positive and a better multiplier than having on the other side the tariffs.
Yeah, let's stay in the US for a second. You've long wanted to grow there, and you've made some investments in the Scout brand, for example. Now, things have changed. President Trump is cutting back on EV aid, the tariffs we've already discussed. How do you adapt your North American strategy to those new realities?
Yeah, we are investing heavily, for example, in Scout or in Rivian and other tech partnerships in the US, and we see still a huge growth opportunity for Volkswagen Group with all our brands. And Scout is one positive example to enter now in the biggest US car segment, pickup segment, and the huge rugged SUVs. And Scout stands for this segment. To bringing back a heritage US brand to the market. And what we are offering there is also a car with range extender. You have an internal combustion engine, and offering a huge mileage with these cars, around 800 miles. And I think that's very attractive for the US community. And the car is stunning. We were able to present it also yesterday here in Munich. And everybody is excited, and also the first order intakes are very, very positive for this car.
So no changes to Scout. You're doubling down on that brand and that introduction.
Yeah, we are counting on Scout, and this is one very important driver of our growth strategy in the US.
Your more luxury brands, Audi, Porsche, have struggled with profitability recently. And, your budget-oriented nameplates, Skoda, for example, have done really well on that front. How do you explain that, and what's the outlook for getting those premium brands back to premium margins?
You have to distinguish the circumstances. Brands are playing, Skoda's only playing in Europe, and has got a very low level of labor costs, mainly in the Czech Republic. On the other side, Audi and Porsche are global players in terms of Porsche. Porsche's in the so-called sandwich positioning in between China and the US. The luxury market broke down over 80% in China, and that counts over 25% of the Porsche volume. And on the other side, we have the tariff situation in the US, and this puts Porsche under pressure because both markets are counting over 60% of the Porsche volume. We don't earn any money on this. On the other side, Porsche has a perfect product portfolio, completely new, having record sales in the most of the Porsche markets. But on the other side, we are currently not able to compensate it. And in Audi, we switched the whole product strategy of Audi, a complete restructuring process of Audi. We were able to present the new Audi design language yesterday here at the IAA. And the Audi Pass is also very, very promising. but we have to fight against the circumstances these global players are faced currently.
That was Oliver Bloom, the Volkswagen CEO, speaking to Bloomberg at the Munich Auto Show. If you want to follow along and see some good pictures of some newly released cars, T-Live blog is where to go for that. Let's check ahead of the risk events on the horizon this week for markets. Today is the big vote in France. The French Prime Minister Bayrou's government looks to fall later today on that vote. Tuesday, Apple unveils a new iPhone 17. Focus there on what kind of price hikes on Apple's new devices. Then on Wednesday, we turn to U.S. data. We have U.S. PPI, U.S. CPI follows on Thursday, as well as the ECB rate decision. And then on Friday, some more hints about U.K. growth. We have U.K. monthly GDP in a week that the U.K. and I guess London especially suffering from tube strikes.
So guys teasing me that the ECB event's going to be a non-event. They're expected to
Tell me why it's not going to be a non-event.
Well, the forecasts in themselves are interesting.
Okay.
We've had the US-EU trade deal since the last time.
Okay.
The base case, well, this is somewhere between the base case and the severe scenario, so I'm looking forward to the projections. I'm also interested to hear what Christine Lagarde, a French woman, will say on the French policy.
When do you think the ECB is going to next move rates?
I like the way you used the word move rather than cut, because it could be a hike. Well,
exactly.
Let's ask an expert, shall we? Someone who spent 14 years at the ECB, and that's Jens Eisenschmidt, Chief Europe Economist over at Morgan Stanley. A very good morning to you, Jens. Just talk us through what the bar is to move, as Guy has put it, again for the ECB. Is the next move actually going to be a hike?
Good morning. Yeah, and indeed, from our seat and our forecast, it's not a hike, it's a cut. But as you rightly say, the bar is higher now, that everybody agrees we have reached a level which is broadly neutral, 2%. And I think right now what we are seeing is a council in wait-and-see mode. They have, if you look at the accounts from the July meeting, introduced a new intellectual baby, I would like to call that, that will travel with them for some time, say a high option value of waiting. And so here we are waiting essentially on clarification whether the tariffs have a bigger impact than thought, or an impact as big as thought, or maybe less than that. And how much is fiscal doing to inflation, if you want. That's a very rough description of the sort of questions they are asking themselves. And so the September meeting will be a prime occasion for wait and see. If you ask our specific forecast, we have a cut in December, so we think that weak data will arrive very soon, and another one in March.
Jens, on your call for a December rate cut, we've had quite some hawkish language from the ECB. Our own Bloomberg's ECB indicator shows that their most hawkish language in a few years. We had Isabel Schnabel talking about how global rate hikes could be earlier than expected and that inflation risks are tilted to the upside. What are you seeing in the data different from the hawks at the ECB?
Well, I mean, first of all, I would say that even the ECB says that for now they expect inflation to go down. We have an undershoot next year. They project 1.6, we think, and I think have done so in June. We have 1.7, so in general the market price is the same, so inflation is set to go down. Now the debate you can have is whether that actually is only a one-off and then in 2007 it goes up, and that's probably where Isabel Schnabel comes from. Again, if you look at the accounts from July, I would say there were more governors, just looking at their language that they use in the accounts, more governors concerned with downside risks than with upside risks. I think ultimately the language in a moment when you are waiting for data, you don't really know. The language doesn't matter as much, I would say here, because it can change very quickly with data. So I think here I would discount a little bit. If there was hawkish language, then I would discount it a little bit, and I would say the data looks set to come in weak. And if that happens, then the December cut is more likely than not.
Jens, we are waiting for the German fiscal push, the impulse that will give the Eurozone economy a leg up. Is that going to happen? When does it happen? And can the ECB really be cutting with that about to happen?
Yeah, no, I think this is the interesting question here because it basically culminates everything in one country. If you look at the European growth prospects, so think weak growth, weak inflation, right? We look at France, doesn't look great given the political uncertainty, and we project 06 this year, 06 next, so that's not a great run rate. Italy, similar. There's a bit of an exception in Spain, but even there you see some deceleration. So basically everything told, it is really about Germany. How will German growth perform? And this is the most affected economy from the trade headwinds. So essentially it's a question, what's worse, trade headwinds or the push that you get and then the inflationary impact that you might get from the fiscal. Now, on your question, fiscal is going to take time and it's going to sort of be affecting only one country. So even if you are very positive about it, it's affecting the country most affected negatively by trade, and it's only 27% of the euro area. So it's very difficult to construct an upside risk, a meaningful upside risk to euro area inflation from that. So yes, to your question, you can cut even if there is a fiscal stimulus in Germany.
Jens, you know Madame Lagarde very well. I wonder how you think she's going to field the inevitable questions on French politics, how much you think the uncertainty is going to weigh on the euro area economy, and whether you think that actually the ECB would ever intervene to save the oats market if needed.
So I think this is I think the ECB tends to see this from a very technical perspective. First of all, presidents are typically very well advised, and they have, so far from what I have seen, always steered clear of commenting on national politics. So I think that will be her line in the press conference. Similarly, on anything that relates to bailing out, in inverted commas, bond markets, I mean, they have their tools, and they look at that from the perspective of transmission. In particular, the TPI would be one in which, for instance, you see a rout in the French bond market affecting other bonds in the market. So basically, Italian yields going up. That's a clear case for the ECB to think through this and think whether that can be activated. For the French, it's much more complex because, of course, there is an element of looking at fundamentals. How much is essentially to do with the deficit that is not being reined in, potentially. So that's a less clear-cut one, but it's clear that if there are disorderly market conditions, the ECB has all the tools and will very likely also not shy away of activating them if that were to hamper transmission of monetary policy.
Yeah, you wonder what conditionality the French will be prepared to look at. Jens, thanks very much indeed for joining us. Jens Eisenschmidt, Chief Europe Economist, joining us from Morgan Stanley. If the Fed cuts 50, does that change the outlook at the ECB? Does it make it easier for the ECB maybe to cut rates coming up? I don't know.
Well, I mean, that would have an FX implication, perhaps.
Yeah.
The euro being stronger, maybe that would hamper economic growth in some way. Those companies that are exposed to higher FX. But I don't know. I think it's more down to what he was saying there about how these growth dynamics end up impacting the euro area economy, and whether that itself opens up the door.
Is another 25 bips from the ECB going to make much difference in terms of the growth dynamics? They've already cut aggressively at this point, haven't they? The cost of money is coming through now. We're not seeing that much of an effect in terms of the growth trajectory that's being delivered from that.
Yeah, in terms of the growth trajectory, we've got these German industrial production numbers rising for the first time since March. Guy, you tell me I should not...
They're fairly choppy, those data series.
Put too much emphasis on these volatile numbers.
OK, that wraps things up. We're over and done with Monday. The tube strike continues. I just want to point that one out. But the Pulse is going to be up next. Plenty to discuss. It's going to be a busy week. Hope you enjoyed the show. This is Bloomberg.